going on. Anand Tandon of JRG Securities joins in with his view now. Morning Anand, good to see you again. What's your sense? It's been a bit of a grind the month of May. Are you expecting a better June or things to be like this for some more time?
No particular trigger then. I think now the action seems to have shifted beyond the results into the monsoon, and right now monsoon seems to be okay. I think the one thing that can take the markets up would have to be commodity prices coming down even more sharply than we have seen in some of the commodities. I think there is a case for some of the metals and perhaps some of the energy related commodities to come down. The unfortunate thing is that it looks like that the food grains will actually rally up again in terms of prices, and therefore really speaking, inflation is not likely to head down anytime in the next quarter at least. So effectively you are looking at a scenario where you may have some selective opportunities as the food commodities start to move up. So the FMCG companies will perhaps be able to pass on some of the price increases. But in the broader market, I don't see anything that will kind of take it up, and especially if metals etc. start to fall off, then some of the heavyweights in the index may actually start to feel some pressure.
Anand, morning. What did you read into that petrol price hike, and what ramifications does it have for the market first and then for the sector?
I don't know if there is anything new there, Mithali. Obviously the price was expected post the election. I think people are dismayed only that it has come so quickly immediately after the election results. But given the kind of price rise that we've seen in crude, either they had to increase the subsidy bill or raise the prices. Obvious impact will be on inflation. I think as they pass it on to diesel, I think they may have to. The impact will be slightly more. So again another notch up negative for the inflation figures. But beyond that, it will begin to impact some demand in the longer term. Near term, I think it's nothing that the market shouldn't have already figured out.
What is the risk, Anand, that over the next 3 months, as we grapple with high inflation, maybe higher interest rates, that this market gets marked down a bit more from where we are standing? Or do you think much of it is in the price and we probably do some more time correction, but do not lose too much on price?
Then if the market corrects, I think it will give you an opportunity to make some money. If it doesn't, then there is really not much in the market right now. Given these double-digit returns you're getting in the debt markets and some of the other asset classes, there isn't that much to actually invest in equities. So if there is a time correction, it is very bad for for investors. You just have to wait it out. Now if you look at the valuations, we are now in the mid-range of where the valuation should be, assuming we end the year with some 1200 rupees on the Sensex. We are trading at 15 times, which isn't expensive but it isn't cheap either. So it's exactly where it should be, and therefore if you get a time correction, as I said, there is no particular reason to rush in. However, if you do get a 10% fall, then I think it would be a nice time to actually begin to start looking at the market and perhaps put in some serious money there.
Where do you fear though, Anand, there may be the greatest markdown in terms of earnings? Will it be this rate sensitive family because of the way inflation has been trending, or do you think it will now become these commodity related sectors because of how sharply commodity prices may start to come off?
Well, I think in terms of the delta, the commodity related sectors will probably show the biggest impact. Especially metals, for example, they may actually show, of course the prices have already for the stocks come down quite significantly, but that said, you will probably find that in terms of earnings they can also slow down quite a bit. I would expect that higher interest will actually eventually feed into lower demand in many forms, especially on the infrastructure side, and consequently you should see a demand erosion as well for many of the construction and the commodity and steel and cement kind of related sectors. So I think in all those cases the earnings may actually take a tumble. I mean, cement, for example, as I mentioned even last time, has been a great outperformer in terms of both prices as well as profits, and it's a question of getting into the monsoon. Seasonally it's a weak time both for steel as well as cement, and also with possible demand destruction because of higher interest rates, it may take a slightly longer time frame to actually feed its way through the system.
Anand, what's going on with the oil space and how would you approach it? Both upstream names like ONGC and some of the marketing companies now post the petrol hike and expectation of the diesel hike.
But then again, I don't think there is a clear call you can take. There has to be another price rise given the current crude prices. And if that were to happen, then I think you may see a little bit more of an uptake on the oil marketing companies. If that were not to happen, and obviously there have been a lot of protests, so I can't imagine that will happen immediately in the next few weeks or so, then the subsidy bill is continuing to build up, and we'll have to figure out how the government will pay for it, because they haven't budgeted enough in the budget at all to pay for any surprises there. So your best case situation is that the crude actually starts to fall, and while we do expect that that will come off a bit based on the fact that there is not that much on the demand side, we don't expect that it will come crashing down anytime soon. So net you're still looking at a situation where it's pretty much dependent on government policy, and more importantly their ability to implement it, and not necessarily something that you can take a call on. So it's always a good time to short the sector after it has had a rally. It's generally safe to do that.
The pullback right now, Anand, is premised on the fact that commodities will fall, but there will be no collateral damage on global equities. Do you think that is a safe surmise to make, or do you think the second half could be extremely difficult for equities as well, if it is for commodities?
Well, I think the only reason one is looking at a slowdown in commodities is that it's been pulled up speculatively very high, and therefore there should be some reversion to the mean. And secondly, because the outperformance vis-a-vis equity is quite high. So therefore, one, the reversion to mean; second, the demand destruction. Both of them will actually hopefully bring it down. Now, if the demand destruction is too much, then obviously that will affect global equities as well. Overall, if you look at it in the US, I think we've already priced in most of the uptick that's happened in the economy. The economy is growing, but not that fast. Europe continues to remain in deep trouble, and there's been a lot of talk for a long time now that China is overheating. So I wouldn't be too sanguine about how the global markets are going to do. However, if the situation does turn for the worse there, then the relative outperformance that we saw of US, for example, for the rest of the emerging markets, we may give up.
Yeah, I'm just going to interrupt you for a second, Anand, and I'm going to get back and get your thoughts on this, because that's extremely important news flashing on our screens. It's